if I were to ask, at cocktail hours, and so this is the thing, is kind of somebody that does international tax, for years people would be like, they'd ask you what you do and you explain that you study international taxation, and they'd try to politely move away from you as quickly as possible in the cocktail hour. But over the past 5 or 6 years, now they're kind of interested in what's going on. Well, if I would ask, this group of people, or we start talking about it, it usually comes down to a conversation about, oh, you're in the business school, multinational companies, they're shifting all this income abroad. And there's a lot of people that would come up with the statistic of something like 40 to 60% of US profits of our multinationals are in tax havens. Work says maybe 50% of the US corporate tax base is lost because of such profit shifting activity. This has had massive ramifications from tax policy, right? I mean, both sides of the aisle are arguing about whether or not we even needed tax reform because they weren't paying what they ought to have been paying to begin with. A lot of this work come back to what we call using aggregate data and data sources that come out of sort of macro, where do GDP numbers come from tax returns, where they aggregate up information across jurisdictions. So in particular, a group of economists have studied, who are well known, have studied this phenomenon. This is where this 50% number comes up with. And a colleague of mine and I, Leslie Robinson, went back and sort of reevaluated some of this data, because one of the primary arguments it's made is there's an awful lot of US multinationals' income in the Netherlands. In the Netherlands, no offense to the Netherlands, but that's typically not where you place a lot of manufacturing activity. It's a conduit, it's where banking things go in and come out, but not very much income is usually left there, right? A dollar comes in as income, but then an expense is paid to another part of the organization, the net's zero. But yet this work finds that billions of dollars of US multinational profits are located in these jurisdictions. And so it turns out that the reason why there appears to be billions of dollars in these particular jurisdictions is because they're holding companies. The Netherlands will typically set up, for a host of financial reasons, because it operates maybe as a treasury function to the rest of the organization, will end up holding the stock of a subsidiary that's, say, located in France or Germany or another jurisdiction. Well, the accounting rules require that the Dutch entity on its separate company books report not only its income and expenses that it generated, but also its ownership of the earnings in, say, the French or German affiliate. So when, for example, the Dutch entity, say, makes $10 from lending money out, it may pay $2 worth of tax to the Dutch authorities. But then the French entity is really manufacturing pharma or aerospace or something, reports $100. The accounting rules will say, well, the French entity will have the $100 in its books and records, but the Dutch entity, in order to make the books balance, reports not only its $10 of activity, but $110, because it reports the French activity. So when you look at the Dutch entity and you infer where US multinational profits are, if you just look at it, you would say, wow, there's $110 worth of profits in the Netherlands. But in reality, right, there's only 10. And so this turns out this is something called the accounting for investment in subsidiaries. And this equity method of counting creates this problem that we call double counting, right? Because if you add up all the activity, if you look at each one of the individual affiliates, in this case you would be counting the French activity once in the French standalone entity, and then you would be counting the income again when you looked at the activity in the Dutch entity. So once we correct for this problem, and the data does allow us for to make this correction in the United States, instead of finding about 50% of the corporate tax base is lost to profit shifting, we find 5%. So it's a pretty significant order of magnitude. It's not just affecting the amount of income you're reporting, it also creates a problem for the tax rates that researchers would see for this jurisdiction. If I make money in the Netherlands again at 10 at a 20% tax rate, they pay $2, right, to the Dutch authorities. And so that's what would show up in the tax expense. But the income would have the 10 and the 100 from the France. So what many researchers do is put 2 over 110 and find a very, very low tax rate. And that's what even defines some of these jurisdictions as havens. And so once we correct for these two problems, we find, still evidence of shifting, but at a far, far smaller magnitude than what's been put out there, and particularly in policy circles.